Have you ever watched a stock explode upward? Panic sold on the pullback, only to see it rip even higher without you? Or maybe you saw a stock surge on breaking news, but you weren't sure if it was a real breakout or just hype. In today's video, I'm going to break down two powerful trading patterns that consistently show up before major moves. The retracement re-breakout pattern on the 15-minute chart, and the news plus high volume breakout pattern. We'll go through real stocks, real percentages, and exactly how these setups played out step by step. Let's dive in. First, let's talk about the retracement re-breakout pattern. This setup usually starts with a strong breakout candle on the 15-minute chart. The main structure looks like this. The breakout candle rises at least 20% from open to high. Within the next two candles, price retraces over 95% of that upward move. Then, price breaks above the previous high again. That second breakout is where momentum traders often step back in. Why does this work? Because the first breakout attracts buyers. The deep pullback shakes out weak hands. And when price breaks the high again, it signals strong demand returning. Alternative version, the gap drop setup. The first candle is bearish. The opening price gaps up at least 20% from the prior session close. Price immediately drops 20% or more from the open, then later breaks above the previous high. This often traps early sellers and fuels powerful continuation moves. Let's start with DRMA. On the breakout candle, price surged 32% from open to high, strong momentum right away. Then, over the next two candles, the stock retraced 103% of the initial move. Yes, it actually pulled back more than the entire breakout. This is where most retail traders panic. But instead of collapsing, price stabilized. Then when DRMA broke above the previous high again, momentum exploded. The post-re-breakout move reached 54% higher. This is a textbook example of breakout, deep retracement, continuation. Now, let's look at the gap drop version with GXAI. GXAI opened with a massive 28% gap up compared to the previous session close. Right after the open, price dropped 22% from the open to the low. To many traders, this looked like a failed breakout. But that drop served as a liquidity reset. Later in the session, GXAI pushed back up, and once it broke above the prior high again, the stock ran another 85% upward. This setup often happens in volatile small caps, especially around hype or early news flow. Now, let's move to the second pattern, the news plus high volume breakout. This one is simpler, but incredibly powerful. The criteria: a candle rises at least 30% from open to high. Volume exceeds 1 million shares, and positive news hits during the breakout. The key idea here is institutional or large trader participation. When big volume meets positive catalysts, breakouts are far more likely to continue. MBAI gave us a perfect example. During the breakout candle, price surged 44% from open to high. Volume spiked to 170,000 shares. And the catalyst was M&A-related news. Traders rushed in on the headline plus momentum. After the breakout, MBAI continued another 56% higher. This shows how news acts as fuel. and volume confirms real participation. So what can we learn from these two patterns? Retracement re-breakout shakes out weak hands, provides cleaner entries after pullbacks, often appears in high volatility stock. S. News plus volume breakout, driven by catalysts. Strong continuation when volume confirm. S. Less retracement, more moment. Both strategies focus on one T. Ing. Letting momentum reset before continuation. N. To recap, DRMA showed a perfect deep retracement re-breakout with a 54% follow-through. GXAI demonstrated the gap drop trap, leading to an 85% continuation. MBAI proved how news and volume can power a 56% breakout extension. If you start spotting these patterns consistently, you'll begin seeing the market very differently.